Hello, everyone. This is Matthew Frailey with BreakpointTrades.com. We've been bringing you advanced technical analysis, market commentary, trade ideas, and mechanical trading algorithms, like you see here with our SPY systems and ES systems. We've been doing this for almost 20 years for individual traders, mom and pops, and professional institutions, which I consult with on a weekly basis. All right, so let's go ahead and get started here. So this right here is our back-end newsletter recorder that we send out via web browser. And anyway, this is the comprehensive weekend newsletter for Sunday, August 28th, 2022. Most of you are aware these weekend newsletters tend to be very comprehensive, usually take about 50 minutes to an hour in length. Now, one thing I'm going to do this weekend, guys, my primary, what I'm watching for on the market short term, I'm going to show you that as the first chart below. That enables it so you get a quick view of what I'm looking for, and you're not dozing off 20, 30 minutes later, where you finally get to that chart. So I'm going to show that what I'm looking for right away first off, okay? But again, if you happen to be new here, these newsletters are very comprehensive. If you're watching this on YouTube, these newsletters, these videos are not flashy, not like a lot of YouTube channels out there where that's the primary focus. My focus is, looking at the charts, giving you an in-depth view, and that's what we do, okay? So again, you can see this weekend's newsletter is divided into 8 major sections. And, these weekend newsletters, we go over the big picture. We'll look at the monthly charts, the big picture charts, all the way down to the smaller time frames. We'll review important indicators, bonds, interest rates, various sectors. We'll look at commodities, and we'll look at U.S. dollar and precious metals. All right. Now, as you know, on Friday, market had a huge sell-off. The S&P lost 142 points, one of the ugliest candles I've seen on the chart. Okay. That came in reaction to Fed Chairman Powell, who basically came out and ended all the speculation that people had out there that the Fed might start pivoting and, lowering their pace of interest rate hikes. Why did people get that view? It's because back in July, the CPI data came in a little less than expected. And people took that to themselves to read more into it, which Steve and I, if you read our comments here, we strongly suggested strongly against taking that as a chance that the Fed might shift course sooner than expected. Steve and I were correct about that. We talked about that in July. Market didn't care. It rallied for about 2 months. And, Fed Powell came out and said, guys, what's wrong with you? We're not even close. We're not shifting anything. And our main focus is getting inflation, untamed and getting it back to its target levels. Okay. The thing about inflation is it's kind of like letting a genie out of the bottle. It's hard to put back into that bottle once it gets out. Another thing, guys, inflation, let's say we had peak inflation and they came out in this summer. Inflation just doesn't go peak and then go straight down. Inflation typically has a slow decline down. All right. So that's another thing to realize. It's going to take quite a while for the Fed to get this under control, and let's hope they can do it without causing too much pain. But that's the other thing. Powell came out and said that they expect what they're going to do to cause slowness and weakness in the U.S. economy. They expect some pain. All right. So also, guys, the thing to think about is their balance sheet shrinkage. They're going to start reducing that. So that's yet another thing for the market. Now, as you know, the market had a pretty good bear market rally for 2 months. 2 weeks ago, it stalled right at the 200-day moving average of the S&P specifically. Logical place for it to do so. And now we've had a pretty good pullback since. What I'm watching for short term is we have the rising 50-day moving average on the S&P and a lot of the indexes. That's likely to at least be an initial support. So if we get some follow through on Monday, I'm watching for maybe reaction bounce off of that. From a wave count perspective, there's 3 scenarios here. Number 1, I can count 5 waves down. So once this 5th wave ends, you should have a decent ABC bounce. The more bearish view would have this sell-off at starting wave 3, which that would be very ugly. The least bearish would have this view as a wave C down. And once it ends, then we're going to rally up again. Some other things, the dollar had struggled at resistance about a week ago, but it still looks strong. Kind of looks like it's forming a bull flag. Looks like I got a typo here. It says bear flag. I'll correct that. Cryptocurrencies look weak. Bitcoin has had a bear flag look forever. It's playing out. Overall, commodities holding up well here. But precious metals, they can't get any sort of rally going. Not surprised. Next. Item number 2 shows the index sector table, what transpired on Friday. Look at those declines for the indexes, down anywhere from 3.4 to 4%. Those are massive declines for one day. And you can see the declines for the week. Pretty much you got the whole week decline in one day. Here's the major market sectors. We follow 20 of them, 21 of them, I think. Gives you a nice broad overview, and you can see how ugly of a day it was on Friday. And for the week, everything was down except for a couple of these sectors, such as energy, metals, and mining. U.S. dollar ended up closing up for the week. Cryptocurrencies were down strongly for the week, as you can see. They're down a little bit here over the weekend as well. And commodities fared fairly well. A little weakness there in natural gas and copper, but not much. Overall, very decent strength for the commodities. See for the week here, everything up pretty nicely. Okay. The coffee had a big week, and actually coffee looks good on a weekly and a monthly time frame. Looks like a bull flag. But, big gains here in the ags. Nice gain in crude oil. Precious metals, well, they got hit. Okay. They cannot get any sustainable bounce whatsoever. U.S. dollar's not helping that. Next. Image number 3. This shows you the economic news calendar for this coming week. And the big one, of course, is the non-farm job payroll report on Friday. Remember, that comes out the first Friday of the month. Again, all these other things are going to be heavily looked at. Anything inflationary related, so be aware, a lot of stuff here. PMI, ADP, housing index, ISM, a lot of stuff this week. All right, guys, let's go ahead and move to the charts. So the first chart here I want to discuss, this is what I'm looking for here. Let me make this a little smaller so we can see it. So right here, I have 2 charts here. This is a daily chart, and I know it's kind of small, but we stopped at the 200-day moving average here a couple weeks ago. I'll just zoom back in a little bit. And you can see Friday's down candle. So immediately what you could see here, you see we broke symmetry here. So this argues for the next rally to form a lower high. These were your previous largest sell-offs, were about 200, 210 points. This obviously greatly exceeding that, down about 278 points off the highs. You have the rising 50-day moving average here in red. So that's a logical little support area short term. It doesn't mean it holds, but you usually get a reaction bounce off of here. If you look at this daily, you can see sort of a, either an ABC down. You can also have a 5 wave. This could also be a 5th wave, or it could be a wave 3. And that's what I'll show you in the next chart to the side. So this chart here on the right, this is a 60-minute chart. And you can see, again, there's 3 potential wave counts here. You have either 5 waves in blue, or this low here on August 23rd is a wave A. This would be in green, the wave B bounce, and then you're declining in wave C. Once this is done, wave C is done, then you would get a very good rally. The most bearish view would be in red, where this initial decline You had 5 waves down in wave 1. This was the wave 2 rally, and we're going down in 3, and it's going to be very, very ugly. Okay, so either one of these scenarios are valid. The ones I favor are either the one in red or the one in blue. Okay, so again, we'll look at these charts again as we get to them below, but let's go ahead and move on to the next stuff. So we're going to shift back. We're going to look at some of our systems. So first off, here's our reversion to mean systems. I actually had 2 of the systems take long trades on Friday. So you can see here on the right side, this is the bear long. And what do I mean by bear long? It's a mechanical trading system that looks for long opportunities in bear market conditions, or really when price is below the 200-day moving average and you have a 200-day moving average with a downward slope. Okay, that's when this system looks for long opportunities. You can see here, you know, just since May, it's had 3 nice trades. It had a monster trade from July here where it picked this bottom, held it for about 5 weeks, and then now it went back long again, a first entry. Remember, these systems can scale in multiple entries. So, you know, I expect a little more down move here at minimum. So it's possible we might see a, you know, second entry, maybe even third entry on some of these. This system here is the S-trap, and it did a nice quick 1-day trade back here last week. Got out, got in, got out, made nice gains, and it decided to go back long on Friday. So these are the reversion to mean systems. They look for trade opportunities in the market. We have 21 systems that we send out trade notifications for, and they've kicked ass this year because they do well in high market volatility, and we're in a bear market and we have high volatility. So again, if you're not a subscriber to Breakpoint Trades, you could sign up so that you can start receiving these trade signals to these systems, and you could simply follow them. Okay, these systems are 100% mechanical. There's no subjective analysis. The system, we let you know when the systems enter the trade. Let you know when the systems exit the trade. They're not trend following, they're reversion to mean. Okay. Next, let's look at the KISS trend system. So on the opposite side, I have these trending type systems. What they're trying to do is they look for long opportunities, and primarily in bull markets, and they try to keep you in an uptrend as long as possible. They're trend following, so that's why they're called the KISS system. Okay, so you can see the daily S&P KISS system for this year. They went long back here in July. The DVTs, think of them as a constantly raised trailing protective stop. Dynamic variable trigger is what that stands for. So the system went long back here. It was able to raise its stop here 5 times, and then of course Friday's candle looks like it's taken out that DVT. So not a big winning trade if it entered back here, but still a winning trade nonetheless. And kind of like my comments here state, this system is primarily designed to keep you invested in bull market conditions and give you a protective stop. But if we're in a bear market, which appears that we are, and that's been our favorite scenario all year long, then usually in bear markets, these daily KISS systems, we either give you a whipsaw trade or just a small winner. All right, but it's done its job here. It gave you protection, and now it's out. Next. Chart number 7, here's a wider version of the KISS trend, and this one gives a little wider DVT right down here near this ATR. Personally, in a bear market, I would use the faster one, but these ATRs tend to be important areas, so this is an important area to monitor down here. Next. Chart number 8, here's the weekly KISS trend system, and it's quite interesting. The weekly here, well, first off, if you look back here, you can see how it went long back in early 2020. And move this up a bit. It kept you long all the way until basically the beginning of the year where it would have stopped out. None of these pullbacks were hit. Anyway, you can see how the market shifted, and this ignored all the bounce opportunities. It actually went long here in early July. It actually went long before the daily, which was interesting. Had that initial DVT stop at the 36.37, which was pretty wide, but it's now raised it all the way up to here. So it actually, that's well above this entry. But besides that, like I said, in a bear market, this isn't, the weekly is not something I'd be following personally, but it is interesting to watch because you could see how 2 weeks ago, price stalled right at this weekly ATR here. Stalled there perfectly, just like the S&P stalled at the 200-day moving average. Next. Chart number 9, here's the various cycle time frames. So multiple time frames here. The daily's up here. So cycles, what I mean is the cycle indicator. These are the magenta is cycle resistance. The cyan is cycle support. And the A's, and yeah, we also have the DeMark indicator on here. And A is amateur buying. So you can see on the daily we had amateur buying up here. And that little mark at the top. You can see we broke the ATR on the daily. The half day had an amateur buying on a DeMark 9. It's perfectly timed that high. You can see we fell below the ATR, became resistance. So resistance, the ATR, and all these time frames. Here's the 130-minute chart. Remember, there's 2 of those in a day. You can see the DeMark 9, 13, marked that top. ATR became resistance. And on the 60-minute, we had a bearish rally here. That worked. Now, what's interesting here, it's showing an end of bull cycle. Next, let's show some other charts, and I'm starting to put these back on the website, guys. So here's the KISS system on some individual stocks, and these are some major held stocks. So it's Apple. So on the Apple, you can see the KISS system showed a long entry back in early July, that vertical line. It also showed a long back here in early May. Remember, it's not perfect, so that would have been stopped out at this DVT. This one back here would have made a little money in March, but this one here was a nice entry. And you can see it was able to raise its stop 3, 4, 5, 6, 7 times. Now the stop is 162. So even if that stop is hit, it ended up being a very nice trade. Next. Chart number 11, here's Microsoft, another widely held stock. You can see this one went back long in early July as well. Raised its stop many times, and that DBT would have been hit at 272.90. Next, chart number 12, here's GDX, that's the gold miners, and this has done very well this year. So you can see it actually shows a long back there in February. It held that long for about 3 months. Then the DBT then got hit there in April with this gap down, and it's never tried to buy again since. So you can see that last buy stopped right at the ATR there. So, you know, it's done a very good job about keeping you out of trouble and actually having a little nice trade. So some of these I now save on the website. You got to go to the systems section of the website. I'll show that here. Systems section of the website, and it's going to be under the miscellaneous. S&P and Qs are there. All right, let's go ahead and move back to the traditional charts. So here, this chart shows you a monthly view of the major indexes. As you know, we had the bull market, which started back in 2009. And then the market had the really good sell-off there in February, March 2020, and then it went vertical. Basically a blow-off to the previous bull market, as I discuss here. The market sold off sharply this year, found support at these lower Bollinger Bands. We've had a 2-month rally here, which you can see by the monthly candle, was up sharply and it is now reversed sharply. Next. Chart number 14, here's a weekly view of the major indexes. So the last rally, as you know, stalled near this downtrend line on the S&P, 200-day moving average. Here's the Dow, similar. So under a bearish view, guys, you know, we could go all the way back and make new lows. Next. Chart number 15, here's a daily view of the major indexes. So the Dow at the top, you can see it basically had a little Pinocchio move over this downtrend line. And that's an important thing, guys. In technical analysis, whenever you get a break of a trend line, be mindful that sometimes it's a false break to suck you in. You want to see confirmation, and it didn't. It basically broke it and then reversed. Here's the S&P. It didn't even break its trend line. You can see now we're near the lower Bollinger Bands on these other indexes. Next, Chart number 16, here's a yearly view of the major indexes. And haven't shown this for a while, but we can see where things are for the year. So the Dow's down about 11.2%, S&P down about 15%, NASDAQ down 22.5%, small caps down about almost 15%. DBC commodities still up 28%. Remember last year I said they were in a bull market, and that's a really nice move. And bonds have been in a bear market, down TLT 20-year bonds down 22.5%. Next, chart number 17. Now let's move to the S&P charts. We're going to start from the bigger picture view and move down to smaller time frames. So this is a yearly. Each candlestick is a year. And I show you this because think about the 9-year EMA as kind of a mean. Price eventually works back to the mean. You could see in these previous bear markets. In fact, it undercut it. Well, you could see in 2020, we undercut it too quite a bit, and then of course sharply recovered. But look how far we still are away from the 9 EMA. To me, in a normal bear market, this would be a target that's still way down there in the low 3,000s. Again, that's just normal price movement. We got way too far away from the 9 EMA, the mean. Next, chart number 18. Here's a monthly view of the S&P. Shows it back to 1994. Very nice, simple chart. As you know, we had the bear market in 2000 to late 2002. We had the 2008 bear market, and then we were in a bull market after that. But one interesting thing on this chart is this indicator, the 14 stochastic. This 50% area tends to be big support in corrections during bull markets, and when it falls well below 50%, you tend to be in a bear market. Kind of like back here in late 2000, it fell below here. That was a bear market. Same for the 2008 time frame. Well, you can see how earlier this year this fell below the 50% area, also confirming a bear market. What I surmised here earlier in the year was a 2-month rally and then another decline, and you could see that is playing out. Some possible targets would be these lower trend lines, one connecting the low of these candle wicks, another connecting the bodies. I hope that's all we get, guys. Next, chart number 19. Here's another monthly chart. We've been showing this since the beginning of the year and late last year. This completed bull market of a 5-wave top. We've said way back in early January that we started a bear market, and so far you can see in this channel we pulled back a little more than 50% of that channel. Last couple months we had a little rally, well off those highs now. So under a bear market, I'd expect to move down at least to this lower channel line, if not down even further, given the backdrop of everything. Next, chart number 20. Here's another monthly view of the S&P. This is the chart I've shown before. Again, we had that, remember, the February-March 2020 correction. That was not a bear market. Bear markets don't end in 1 month, guys. It was a sharp correction, a bull market. Then we had the parabolic blow off top with all that stimulus money, all that money in the system, and ended that bull market with a blow off. And now we have to correct that. So here's some longer term demand zones, support areas, the lower 3,200, 3,300, and I would think that price would possibly retrace that whole blow off move, and so you could see a move down to the low 2000s. I know that seems impossible, but you guys never know, and it would not shock me if a year and a half from now prices were down into these areas. Just something to think about. Next, chart number 21. Here's a 90-year chart of the S&P 500. As you know, we've been showing these nice channels on the markets, the 60-minute, 120-minute charts. I just showed it monthly above. Here's a clean channel on a monthly or a 90-year chart. So, could price correct eventually to the lower portion of this channel? That's around the 2,700 area on the S&P. That would be a normal price target, normal price projection, and a nice uptrend, long-term, secular cycle. Okay. Now where you get issues if you break that, but you can see, guys, just going down to this lower channel of this 90-year chart would be normal, okay? And that would have the S&P set in the 2,700, 2,600 area. So don't think that's impossible. Next. Chart number 22, here's the same chart, but for the Dow. The parallel channel lines are in black. And of course, the blue line here connects the 1932 lows and the 1982 lows. Next. Let's move down to smaller time frames now. So here's the daily view of the S&P that I showed as my first chart. So again, you can see, we had basically a two-month bear market rally here from the June lows. First move up, ABC consolidation here, about 210 points for these pullbacks. And then a sharp rally there into mid-August, where the S&P stalled right at the 200-day moving average. Didn't quite make it to its downtrend line here. And look at Friday's sell-off. Just one unbelievably ugly candle off of Fed Chairman's comment. So we've obviously broken symmetry here. 280 points down from the highs. So anyway, what you have here now is the 50-day moving average coming up. To me, on a further move down on Monday, this would be an area to watch for a reaction bounce. If you're short, this may be an area you want to cover some. Okay. Next. Chart number 24, here's the Rinko chart we've been shown, and this actually gave a really good sell signal. It's actually followed the market pretty well. So it caught a lot of that move from July into mid-August, then it went on a sell, and it's been pretty good. Next. Chart number 25, here's a half-day, 195-minute view. Again, we didn't quite make it to this downtrend line. We had the 200-day moving average. This was an area we were watching for the market to reverse. It was a good area to load shorts. Now we're at the lower portion of this channel. Next. Chart number 26, here's a 2-hour view. So, week and a half ago, nearly 2 weeks ago, remember we were monitoring these steep uptrend channels, and we said breaking those channels would be bearish, and it was a shot across the bow. So once you broke these uptrend channels, that was the time to be extremely cautious, look for shorting opportunities. We sold down, then we had a lower high bounce here, and of course Friday we cratered. So once we broke these channels that we showed day after day, that's when you guys should have gotten really defensive, maybe even look for some short opportunities. Next. Chart number 27, here's a 60-minute view. This is the chart we were also showing last week. First off, you can see the channel, which again, once we broke this channel, that was significantly bearish. We also last week showed this head and shoulder pattern. We got that bounce, and lo and behold, this is playing out. Now, these gaps have been pretty good target areas. There is an open gap way down here. Could we just go right down to here? That's a possibility. Or another view, if we were to bounce here and test this broken neckline, that could be a resistance to look this area to re-add shorts. Okay. Here's a symmetry move. So if you measure the move down, subtract it from here, this gives you another target. We'll see what happens early on Monday. Next. Chart number 28, here's the 2-hour view showing this channel. We're based at the parallel channel line of the larger channel. Again, you can see the smaller channel here that was breached almost 2 weeks ago that I just discussed with the 60-minute and 2-hour chart above. So kind of little fractals. These shaded areas show you gaps. We got this gap down here. We got a gap down here. The S&P cash loves to fill these gaps. So this gap here was a magnet on Friday. We filled that. And now, do we go straight down to this gap, or do we bounce around the 50-day moving average? We'll see. Next. Chart number 29. Here's that 60-minute chart I covered as well early on. So these are the 3 scenarios, guys. So from the highs at 43.25, you have one count in blue. Wave 1, 2, 3, and then 4, and then 5. Under this scenario, once this wave 5 ends, we should have a pretty good ABC bounce. And what do I mean by ABC bounce? Something like this. A, B, C. Form a lower high because of the symmetry break, then you would come down again. Okay. Wave 5 could end here anytime or right now or at the 50-day moving average, something like that. The bullish view is in green, which I don't really support. Would have us working on wave C. This should be wave C here, not B. And once C is done, then you'd rally strongly back, maybe to the highs, the recent highs at least. The most bearish view would be in red, where this whole move down here, you could count 5 waves here as one. This was a wave 2 bounce, and then now you're moving down in wave 3. Remember, wave 3 is the strongest wave, and that under that scenario, things would get really ugly. You can see how the moving average ribbon bearishly pinched here late last week. So we'll see, guys. The scenario I'm favoring is in 3 or maybe even red. Probably not the green scenario. That's kind of what would be the alternate view. Let's hope it's not this scenario in red, but these are the 3 scenarios. Next. Chart number 30, here's another 60-minute chart of the S&P with just fibs. You can see we're right around the 38% fib here. Next. Moving on to the triple Qs. Chart number 31, weekly view of the Qs. Again, down about 4.8% for the week. You can see the moving average ribbons. We're pinching here on the other side. Just like back here in March, you had the bearish pinch. See how useful just the moving average ribbons are? Nice subjective, useful indicator there. Next. Chart number 32, here's a daily view of the Qs. They didn't make it to their 200-day moving average like the S&P. The last time was back here in March. Okay. It's a big, ugly move down on Friday. You have the 50-day moving average here, which could be a support. I also added an uptrend line here from the lows. Gives you a little more room. So down in this area, watch for a potential reaction bounce. Moving average ribbon for now is still bullishly stacked. Next. Chart number 33, here's a 60-minute view. So just like on the S&P, you had these nice channels. Once those channels were lost almost 2 weeks ago, that was the time to get very defensive. And you can see we've retraced about 50% from the move, from the low here. Next. Chart number 34, here's the daily KISS system for the Qs. The DVT was hit on Friday with that big move down, but it was still a profitable trade from this entry. It was able to raise the stop by 6 times. Remember, these KISS systems do better in bear or in bull markets when you're generally uptrending. Next. Chart number 35, here's the cycle time frames. Very similar look to the S&P. You had the amateur buying on the daily. We lost the ATR. You had the DeMark 9 and amateur buying on the half day, which marked that high. ATR resistance is now, well, it's resistance in all these lower time frames from the 60-minute, 130-minute, and half day. Just like on the S&P, we have an end of bear cycle down here. We'll see if price bounces from that or not. Next. Chart number 36, IWM small caps. They made it a little over their 200-day moving average and then reversed, as you can see. Next. Chart number 37, here's the 60-minute view. So one thing I discussed last week in my newsletter was that IWM had a symmetry break here. The pullback at this point was about 12 points. It was larger than this pullback back here in late June of 11.4 points. That argued for a lower high, which we got. So symmetry ended up playing out here. It's also near the 38% fib from the low here. So that does it on the major indexes, guys. Again, we'll see what happens here come into Monday. I think futures are down this evening as I'm recording. Next. Let's look at some market indicators. Chart number 38, here's the VIX. As you'd expect, VIX had a big pop on Friday, closing outside the upper Bollinger Bands. All right, that's keynote. But what you worry about is the VIX could have an instance like this or back here where it closes outside the upper Bollinger Bands and runs for a bit. So let's hope we don't have something like that. That would be under that wave 3 scenario. All right. Another thing to note, this correlation indicator, when the VIX was uncorrelated here, that ended up marking the top was a pretty good topping warning sign. Next. Chart number 39. Here's the VIX with the DeMark. One of our astute members had pointed out that DeMark tends to work very well on the VIX because the VIX doesn't trend like the market. And you can see here, DeMark 9s calling these highs very well on the VIX, highs and lows. We had a DeMark 9 back here in August, which called that low on the VIX just perfectly. Next. Chart number 40, here's the CPC put call ratio. It did close outside the bands, so be aware of that. You know, outside the bands. Sometimes when you get outside the bands, you're usually around some sort of trade low. But again, it can stay outside the bands for a couple days. Overall, though, the CPC is fairly low from what it was back here. Next. Chart number 41, here's the bullish percent S&P with the Rinco. Very clean chart. This also played out well. It gave you a buy signal way back here in June. Gave a sell signal back here in August. Next. Chart number 42, here's the inverse XLP S&P ratio. And I noted that the ratio here, tends to move with, this moves with the market. But notice this last rally couldn't get above here. So you technically had a divergence between the S&P, which took out that May high, June high, but the May high, but the indicator did not. Next. Chart number 43, here's the NAHL, NASDAQ new highs, new lows, plotted as a cumulative. This gave a strong sell signal back in December when these moving averages crossed. But notice here, on this huge rally, this thing didn't even frickin' budge, did it? It didn't do anything. So that was warning. Next. Chart number 44, here's the S&P versus the high yield corporate. They tend to move together. But sometimes you get divergences like here. The S&P made a higher high. High yield corporate did not. That was bearish. And recently, the S&P made that slight higher high. But the corporate bonds did not. They formed a double top. Next. Moving on to bonds. So here's the daily high yield corporate. So it had a pretty good rally from the June lows, just like the market. Didn't make it to its 200-day moving average. Came all the way down to its 50-day. You can see how it did bounce off the 50-day. Maybe we'll see something like that with the S&P. But then, of course, Friday, ugly candle right back to it. Next. Chart number 46. Here's the TLT 20-year bonds. Trying to bounce here. Steve shows a possible higher low inverse head and shoulder pattern. It's not an ideal pattern, but something to watch. Next. Chart number 47, here's the 10-year treasury yield. It's basically rallied back to the 61.8 fib. This is an area where it either fails and comes down or it rallies. Long term, I expect the 10-year to go much higher, but short term, we'll see what it does here. Next. Chart number 48, here's the 40-plus year chart of the 10-year treasury yield. As you know, interest rates were sky high back in the early 80s. They started a secular bear market. You can see you can draw a nice parallel channel here. And once price broke above this parallel channel early this year, that told you that secular bear market and interest rates was over. So it broke this 35-year channel going back to 1987. So you can see price found support at the broken channel line. And I'd expect over time, interest rates will go much higher. Again, it's not a bad thing. Savers will be to get some interest rate return at the banks, CDs, whatever. Next. Chart number 49, here's the yield curve. As you know, yield curve is strongly negative. Again, guys, this happened quite a bit earlier, and we all know we're in a recession, despite the fact that the administration changed the rules. No doubt about it, we're going to have a recession. We're in a recession, okay? Next. Let's look at some individual market sectors. We're not going to look at all of them. So here's XLE Energy. So notice so far we've had a symmetry move right into here. We're finding some resistance here. So does this pull back from here? Or is that a high, or is it just going to be a short-term pullback? We'll see. But struggling right now with this symmetry. Short-term supports the 9 EMA. Next, chart number 51, XLK technology, got up to its 200-day moving average just like the S&P. Of course, big smackdown on Friday. Didn't even find support of this broken downtrend line. Next, chart number 52, IYT transports. This also got up to its 200-day moving average. Got smacked down from there. Next, chart number 53, biotech. Monitoring this rising 50-day moving average. We'll see if we get a bounce there. You can see we had 5 waves up. Next, chart number 54, banks. Big sell-off, as you know, on Friday. You have the 50-day moving average here to monitor. See if we get some bounce there or not. Next, chart number 55, semiconductors. Closing right at its 50-day moving average. To me, this looks like a weak shelf support. Losing this could have a vicious decline. Finally, chart number 56, XOU utilities. This sector's been on fire, but profit taking is occurring. And it closed slightly below its 20-day moving average. Under a good decline in the market, everything will get hit, guys. Realize that. You're not going to have a safe haven anywhere. Moving on to commodities. Chart number 57, DBC, commodity ETF, end up closing up 2.6% for the week despite the drubbing in the market. But guys, given the fact that this was the largest sell-off in the uptrend in this bull market started back here in 2020, I think this is going to form a lower high ultimately. I don't think it goes to a new high from here. It could be wrong, but I think it goes to a lower high, then comes down again because we did have a symmetry break. Next, chart number 58, here's the daily. So, we found support of the 200-day moving average twice, once in July, once in June, and we're still kind of unable to break out of this range here. We do have support down here at the 50-day moving average. Next, chart number 59, crude oil. I stated, remember, a couple weeks ago that this 85 area would be big support. It was resistance back here, so you'd expect it to be support. And it became support back here where we rallied off of. It was a good buy opportunity here. But for crude oil to start another uptrend, needs to get over this 50-day moving average. Next, chart number 60, natural gas. That's been on fire. And if you live in Europe, you don't even want to talk about it. It's a bad word with what Russia's doing with natural gas. That's another time for discussion, but potential rising wedge here forming. Next, chart number 61, here's UNG, natural gas ETF, 60-minute time frame. Could be a little head and shoulder forming. Next, chart number 62, copper. Again, it's had a nice rally off those July lows, but to me, it looks like a big weekly bear flag. Next, chart number 63, DBA, agriculture so far. Put in a low in July. It's been a little choppy uptrend. Still below its 200-day moving average. Next, chart number 64, coffee. This is a monthly chart. You had a perfect double bottom low back here in 2019. And really, this looks bullish. Looks like a big monthly bull flag. Next, chart number 65. Here's the weekly chart breaking out of this bull flag channel. The way to play it is, I think it's JO. That's the tradable ETF. Next, moving to Bitcoin, chart number 66. Bitcoin, it had this bear flag look to it forever. Broke down last week. It's below this channel line, which is now resistance. Next, chart number 67. Here's the weekly chart. I've said for a while this weekly chart is extremely ugly. I've been calling this as a bear flag, and you can see the last 2 weeks it's selling down here. Now, guys, longer term, I think Bitcoin could go down to this range. What do you think would happen in the general market if that occurs? Next, chart number 68. Here's another weekly chart of Bitcoin showing a symmetry move. Notice how the symmetry projects conveniently right down to this big supply zone. Next, chart number 69. Here's Ethereum. Likewise, broke its support. It's below its 50-day moving average now. Next, chart number 70, US dollar. It's been on fire. Broke out of this bull flag in August. It stalled logically up here, kind of a little double top. But, we'll see if this is a flag forming that eventually breaks out of this. Next, chart number 71. Here's the tradable ETF UUP. Same look. You can see volume with it, though. unlike the index. Next. Chart number 72, here's the monthly chart. This 104 area is resistance. We obviously took that out strongly. And your next resistance is here, going back to 2002, and then, of course, the highs in 2001. Next. Moving on to precious metals, chart number 73, gold. So gold, had this big multi-year rounded top, or rounded bottom, rallied up. We had a double top, which was earlier this year. Gold was able to get above that, and it's just been down ever since. Gold's been down 5 months in a row now so far. Next. Chart number 74, here's the weekly chart again. One way to look at gold, this channel. This is your big support, which we did bounce off last time. This was your resistance. Next. Chart number 75, here's gold on the daily chart. Can we form a higher low because of the symmetry break? We'll see. But you need to see the stocks outperform the GDX-GLD ratio, and they are underperforming. Next. Chart number 76, silver. Just looks ugly. What can I say? Next. Chart number 77, GDX, gold stocks. Again, we're unable to get much traction here. They look like they want to make a new low again. Ugly. Next. Chart number 78, GDX 60-minute chart. You can see how they stalled right at this double top resistance. Next. Chart number 79, the last chart, BPGDM, Bullish Percent Gold Miners Index, plotted as a Ringco chart. It's a nice clean chart. First off, this had a nice MACD divergence back here. But since then, look at this thing. It's been straight down. BPGDM was up here at 82.5% back then in April. It's now down at 11%. It has not even tried to bounce. This area has been ugly, not surprising given the strength of the dollar. All right, guys, that does it. We'll see what happens with futures the rest of tonight and, of course, on Monday. Have a great evening, the rest of your Sunday evening. Take care.